Hey guys, in this video I'll go through price action analysis and how to spot when a trend is shifting or when something might be changing in the intraday trend, so you can make smarter trading decisions. By the way, click the subscribe button and hit the notification bell so that you know when I release new content. The key to understanding price action analysis, and more specifically when a trend is shifting, is knowing the concept of peak and trough analysis. Or said differently, higher highs and higher lows, or the opposite of that, lower lows, etc. This is a simple concept but can be powerful if utilized correctly. Also, before we start, comment below what topics you want me to cover so I can tailor specific content just for you. Okay, so what is peak and trough analysis? Let's take a look at the chart here. Okay. Peak and trough is basically higher highs and higher lows, and lower lows and lower highs. So this here is rising peak and troughs. It's a higher high, higher low, higher high, higher low, peak, trough, peak, trough. Okay. Okay, and when do we have an uptrend? We have an uptrend when we have a higher high, a lower low, and a higher high. That's enough to have an established trend. So let's take a look. When you have a high, got a low, and then you have a new high. This is enough to have an established trend. So when does price action signal a possible shift in trend? The first clue is when we get a break of previous low or high. This should trigger the thought process of either the structure is making a bigger correction or a possible reversal. Let's take a look. If you have higher highs and higher lows, then at one point the structure or price action might come here and take out this low, this previous low. This is the first clue that possible shift is happening and something might be changing. This is where I said that either a bigger correction to continue this uptrend might happen, or a reversal. This is where the second clue comes into the picture. The second clue depends on how deep this retracement is. A general rule states that the retracement should be 1/3 or 2/3 of the previous move to be considered as a proper retracement. So in this case, it's 2/3. So let's just recap this quickly. Let me delete this, delete. Here we go. So first clue is we break previous low, structure low. Something might be shifting. Second clue is we got a retracement. Now the moment we come down and break this here, then we are in a downtrend. Okay, let's take a chart example now. So let's delete this and let's go down here. Euro USD. There's a very good example here. Look at this. We have a series of higher highs and higher lows, higher highs and higher lows. And then at one point it breaks this previous low. And now let's just go back a bit. The moment we break here is the first clue. Either we're making a bigger correction to continue this uptrend, or this is reversing. But this is where this concept becomes powerful if you utilize it correctly. You have to know the overall context of the market. Knowing the context of the market, applying a multi-time frame analysis will help you understand whether the probability are higher for this being a bigger correction to go up or reversal, because at this point of time, this is all the chart information we have. We need more data. So with more data, we can put together a much better trade. So let's look at the daily. Let's take a look at the daily. We have an uptrend. Then we have a pullback, right? So we have a series of, again, higher high, then we got a higher low, we got a higher high again, and we got a low that does not break this low. So we're still in an uptrend and we're pushing up. With this in mind, we would assume that this here is a pullback. This is a retracement of this trend. So there's a good chance that we're going up. Because of that, the bias would be to look for upside, for continuation trend to go up. Therefore, looking at this break here of previous low, I would assume that the higher probability play here is a correction, some sort of bigger correction to continue to go up, based on what the bigger overall context of the market told me, based on the higher highs and higher lows, etc. of the bigger market. This is an essential point to understand. You should never trade information in isolation. You should never trade a single indicator in isolation. Okay, because a single indicator is just a tool that's indicating, in this case, a possible shift in trend, that it might happen, that there's a probability it might happen. It's important to have multiple variables pointing at the same probable possibility. Okay, so before making the final decision, you want to heighten the odds of success. This is a concept known as confluence, or weight of the evidence. After all, trading is a game of probabilities. It's not about being right or wrong. So, I'm gonna end it here. But if you want to learn more about this way of trading, or this style of trading, and want me to make more videos of this kind, make sure to hit the thumbs up button and comment below to let me know what you would like to see more of. Thanks for watching.